Hey financial friends, welcome. I'm Jen from FINLITI, and today we're going to talk about the 10 things you need to know before investing your first dollar. So who am I, right? I'm Jen, a financial professional in Toronto, and I know that there's a lot of curiosity about the stock markets out there, so I'm going to show you some strategies that you can use for investing and traders. Stick around, financial friends, until the end for your chance to win $500. Okay, so financial friends, the first thing that you want to do is that you want to open up a bank account. I know, it seems like it's counterintuitive. Why is this girl telling me to open up a bank account? But the thing is that a lot of people don't have their own. They have one either joint with a spouse, with a parent, or whoever else, their dog, I don't know. Anyways, the point of it is you need one account and you need to be able to make decisions in this account about financially related matters, because that's what's important. I also recommend only having 2 bank accounts. That's right, 2, maximum 2. It is not diversification having 20 bank accounts across the city. That's an excellent way to lose all of your money and not know where it is. It's like a scavenger hunt. You just don't want to do that with your money. It just makes work for you and you want to get rich quick, right? Just kidding, don't say that. Cut that out. So banks like to compete for your business because they are businesses after all. So the reason why you want to have 2 bank accounts is so that you can take advantage of specials that might be at one of the financial institutions that are not at the other one, because they like to compete and get new customers all the time. So use that to your advantage, financial friends. Okay, financial friends, now we're on to number 2. You need to calculate your net worth. So I think you're net worth it, which means that you are worth it. Anyways, that was a terrible pun. So what you do first is you need to know your assets. So assets are things that you own, that are yours. And most importantly, for the sake of investing, for the sake of getting a loan or buying an investment property, you need to know how much money that you have to your name. So assets will be cash, investments such as RSPs, Roth IRAs, 401ks, whatever it is, it's invested. Those are your investments. And then you also have your property market value. So if you do own a property, that would be the market value. If you were to sell it today, how much could you get for that? That would also be added to your asset calculation. So now that you know that, you have your investments, cash, essentially property value. That's what forms your assets. Next, we're going to talk about the liabilities. Liabilities are things that you owe to other people. So essentially the big ones are credit card debt. Now, that's not your total line of credit card debt. That's like essentially the balance that you owe on that particular credit card. That would be added to your liability. Also, if you're looking for a line of credit and you have that owing, let's say you have a car and you have a car loan, that would also be added to your liabilities. Finally, if you have a mortgage, whatever that mortgage amount is owing on your property, that would also be added to your liabilities. So what you do, you add those all up, credit card debt, loan debt, mortgage debt, ta-da, there are your liabilities. So to get your net worth statement, what you do is you take your assets, you subtract your liabilities, and that gives you your net worth. Now, financial friends, please don't get discouraged if it's a negative number. Many people, especially when they're early on in their career and they're just got their first job or whatnot, have a negative net worth. It's just good to know what number you are and where you are, and then to build from there. So every year you want to be able to improve and make sure that it's more of a positive number and it comes to be a bigger number. So that would be your net worth statement. All right, number 3, save a minimum of $1,500. That's right, you heard me. Everybody's like, Jen, how much money do I start with? Do I start with $1? Do I start with 10? No, friends, you start with 1,500 smackaroos. Because if you start with $1,500, it's a good starting point to get you a couple investments to help you along. The reason for this is that, like it or not, the brokerages, wherever you set up your account, often charge an annual administration fee of up to $150 per registered account. Sometimes it's less, sometimes it's more, but if you think about it and you have $1,500, that's like a 10% fee before you even get started. Also, when you're going to buy your spiffy new investments, or mutual funds or exchange traded funds, also known as ETFs, or stocks or crypto or whatever it is you want to do, there is a transaction fee to buy and there is a transaction fee when you go to sell. And usually that's, they say it's free, but sometimes it's not. And you got to be wary of that. Sometimes it's $10. Sometimes it's $30, and sometimes it can be $150. So be very aware of how much you're getting charged. Okay, so number 4, you want to establish a 5-year time horizon. What's a time horizon? That is the amount of time that you dedicate towards your investment strategy or your trading strategy. So when I'm talking about a 5-year time horizon, what I mean is that the stock market has a lot of fluctuations, ups and downs, ziggity-zaggities, whatever you want to call it, also known as volatility. So that can make you panic and that can make you sell at the wrong time. And we don't want that. So if you're going to be investing on the stock market, do it over a period of 5 years. Make sure that you give yourself time to make sure that your thesis plays out. The other thing you want to do is if you're going to be buying a home or a property or a condo, and you're going to be using that money, that lump sum for a down payment, you're best to keep it somewhere safe. Yeah, interest rates are pretty low right now, but it's a good thing to just keep in a plain Jane checking account if you were going to be purchasing the next 1 or 2 years. So that way you don't run into all of these fluctuations that the stock market can have. All right, number 5, keep with the brand names when you're looking to make your first investment. By brand names, I mean like banks, credit unions, places that that are familiar to you, that hold deposits or money. Trusted places, friends. What you want to do is avoid social media people and anyone telling you that you're going to make a whole boatload of money or additional income on either like foreign exchange transactions or cryptocurrencies. Those things are all good and mighty and they might work out in the end. But the thing is that when you're a beginner, you're just beginning, you don't want to invest in those strategies. Because you know what, like it or not, you're probably going to lose on your first transaction. You're inexperienced, you're just starting out, and you're going to need to deal with that. So please avoid those things if you are a beginner until you get a little bit more experience under your belt. And that's why I say stick with the names that like the platforms that that your money is not going to get lost if you do deposit them there. Okay, point number 6, the KISS principle. Keep it simple, stupid. But in this case, I think you're very smart, so it's keep it simple, smart. So what you want to do is you want a simple plan. You need to know when you're going to buy, when you're going to sell, or if you're going to hold. And that's all you need to know at the beginning. You want a very simple plan that you can implement. And if you hear some jargon that sounds fancy and really cool or really innovative, please stay away. Only keep to the things that you understand for now. Avoid all of that fancy jargon. It'll probably get you into trouble. It's okay to make mistakes. You don't have to be a perfectionist. Perfectionism will kill your investment strategy. You need to know when to buy. You need to know when to sell, and you need to know when to hold for you. That is the KISS principle in a nutshell. It's totally fine to make your mistakes, and if you make mistakes, you're going to grow, and eventually good things will happen for you. Okay, you're still with us, beautiful financial friends. Number 7, ignore the noise. I know, right? You're constantly getting lectured about your penchant for avocado toast and for your lattes that you really enjoy. That's great. It's great to have a budget. It's great to keep your expenses in check. However, you do you. You want to do you because that's how you're going to be successful, and you need to come up with a customized strategy that works for you. So ignore the noise. Everybody thinks that they have your best interest in mind, but nobody knows yourself better than you. Know thyself, financial friends, and you will be a true success. So, common myths that I hear, you're going to be encouraged to pay down all of your debt, to pay down all of your mortgages, to pay down everything so you have zero debt. Well, guess what? Fast fact reality, in North America, our system pretty much runs on credit. We are a credit-centric capitalist society. So like it or not, credit is here to stay, and you will have leveraged opportunities as well. So your investment priorities, they belong to you. What you want to do is live within your means and be able to pay your monthly payments, make it manageable, have your income that works for you, contributes to your lifestyle that you want. But the fast fact reality is that we live in North America and credit is king, and a lot of people use that leverage to be able to buy properties, rental properties, whatnot. So don't listen to the noise, don't listen to the haters, don't listen to people's tips. Take them into consideration. Yes, maybe they might be helpful and they might mean well, but really know thyself, know what you want out of life, know how you want to get there, and just listen to what speaks to you. All right, number 8, get a line of credit. Now, I know you're like, but Jen, I don't want to get into any more debt. This isn't debt, friends. Please just hear me out. So you want to have a line of credit in case an emergency comes up. Life is weird, unpredictable, and you know what? Crap happens, and it's just reality. So what you want to do is see if you can get yourself a $20,000 line of credit, unsecured, secured, doesn't really matter, whatever you can get. Have this in place, because it's going to take a little bit of paperwork to get it involved. And you want to look for a lower interest rate. So you're looking ideally for something that's 8% or less. You want it in place forever, or as long as you can, and you want it in place in case something does happen. Now, let's say that you do put a balance on this line of credit. Make sure that you can afford the monthly payment. So if it's going to cost you $100 in carrying costs for this line of credit, make sure that you're able to afford that $100 per month, because you do usually have to put a monthly payment on of some sort of amount. But it's a really good way to not have to save for a rainy day fund and put your money towards better uses and invest it on the stock market. All right, number 9. This is a big one, guys. Big one. Please, whatever you do, if you remember one thing from this whole presentation, pay off your credit card debt. Make it to 0. Zilch, nada, nothing. The reason for this is that credit cards are essentially like the demon of the financial system. You know, you're like enticed by all these things you can buy, all these trips you can take, all these like fun nights that you can have, but rest assured that all that spending is going to catch up with you. So if you can, please pay them down to 0 before you do anything else. 0. That means that you want to pay off all of the balances on your credit card before you start investing in the stock market, in real estate, anything that you have. Please make sure you pay down those credit cards to nothing, because the interest rates are oftentimes 19% or higher. And to be able to achieve this type of return on the stock market is very difficult. And it's very difficult to do it consistently. They can get you into a lot of trouble. They are a very toxic friend. If you need, I understand that they're a necessary evil, because you need to book trips with them, you need to buy groceries with them, you like to earn some points. That's all fair and good, but please, if you can, pay off your credit cards by the end of the month. Now, let's say you can't do that, and I realize that people have credit card debt, it just happens. Make sure you have a plan to pay it off. Like, come up with a plan to pay off the interest plus some principal month after month, and something that you can manage. And now, drum roll please, the moment you've all been waiting for. Number 10, build yourself an FU fund. That's right, financial friends, it is exactly what I mean, and it's abbreviated wonderfulness. FU, build yourself a FU fund, in case you need to hightail it out of there for whatever situation that comes your way. Maybe you have a dead-end job, maybe you have a terrible partner, maybe you have a dysfunctional family. But on a more positive note, maybe you want to start a business, or maybe you want to take a technical degree, maybe you want to get some higher education, maybe you want to buy a house or an investment property. Sky's the limit. Or maybe you just want to build yourself some beautiful wealth. And that's okay too, financial friends. So what you want to do is you just want to start with $1. You want to turn that $1 into $1,500, and you go from there. That's all you need to do as a beginner when you know your 10 basics of investing. You need to start with a plain Jane, non-registered financial account. So start with a non-registered account, it's plain, it's vanilla, it's boring, but it can do lots of things for you. And what you want to do is develop your strategy within this non-registered account. Don't worry about tax-free savings accounts. Don't worry about your Roth IRA. Don't worry about your 401k. Don't worry about these fancy titles within these registered investment vehicles. It doesn't matter for now because you're beginning, and that's okay. And that's exactly where you want to be. Just start. So those are my 10 points. Those are my basics. Thank you for listening. And now, to help you along your way, I'd like to tell you a little bit about the prize that I mentioned at the beginning. Okay, so I've got a bonus point for you. That's right, a bonus point, because it's always fun to win money that you can put to work. You now have a chance to win $500. If you complete the FINLITI questionnaire, my team and I have been working really hard on it, and it's only available for the first 1,000 people. The first 1,000 people get a chance to win $500. The odds are in your favor, friends. They are, and you can use that money to put to work towards your investment goals and your investments or your trading, whatever you'd like. It's there for you, and the link is below. I'm Jen from FINLITI. Please subscribe to our channel for more videos on investing basics and learn with us. If you have any comments, I'd love to hear your feedback. I love feedback, good or bad. I will cover the subjects, the topics that you want to know. I will go over the jargon. Whatever it is you want, friends, I am here for you. You are my FFs, which stands for financial friends. I am so happy that you joined, and I look forward to making some more investing basics videos for you.